Let's speak about Chargepoint, baby. What is happening, investors? It is your boy Jack. I am not a financial advisor, and yesterday after the closing bell, Chargepoint's earnings came out, and to be honest with you, a little bit of a mixed bag in my opinion. Nothing insane, nothing particularly good, nothing particularly bad. As of recording, they are down about 5%. If you did see my video yesterday, I said I expect a 5 to 10% move in either direction depending on how things go. And right now, it's looking like that could come true by the end of the day. It's floating around that negative 5% range. But what we're here to do is, look at the earnings report from a long-term investor's point of view. Take a look at the charts toward the end of it. See what actually happened. See what the outlook looks like another year down the line. So to do that, we're obviously going to take a look at the earnings report, see the good and the bad. Also, a couple of analysts came out and reiterated buy ratings and very good ratings for the company, essentially. Craig Irwin being one of them. And then we will take a look at the GAAP income statement, because I do want to speak in particular about the subscriptions versus network charging systems and their gross profit numbers comparative to last year, both for the 3 months ended and the 9 months ended. And that's the plan for today's video, baby. So right before we do get into that juicy information, could I please ask you, my friend, to hit that like button? It really does help me out a lot. I appreciate every single one of you doing that on the videos lately. And subscribe if you're new around here and want more content in the EV space in particular, with a little mix of other things thrown on in there. So we're just going to start it off with the basics. So Q3 GAAP EPS was negative 25 cents and missed by 2 cents. So right off the bat, obviously, it's not the best thing in the world, but it's a small miss. I don't think it's anything crazy. I don't think it's anything to be too upset by. Revenue of 125 million, up 92% year over year. If you are relatively new to Chargepoint, or even if you are somebody who's been following them since the SPAC days of SBE, one of the things about them is their revenue growth is insane. Now, it does have to be, because we are, pre-profit. So there has to be a reason you're investing. It has to be the growth potential of the company. In my opinion, this revenue growth is fantastic. And I, as a long-term investor, am very happy with the number here. Even if it was missed by $6.78 million. I mean, it's still 92% year-over growth is absolutely great. And I do think most long-term investors will be happy with this, even if it was a small miss. Now, GAAP and non-GAAP gross margin both improved 1 percentage point quarter over quarter, which is obviously, a solid thing. If we do look at the chart, it's quite important to understand that the non-GAAP gross margin, yes, went up 1% quarter over quarter, but it's still down about 7% from the year ago quarter, or 4% from the year ago quarter, I should say. So it's still not quite where it was, but that kind of comes with the territory of getting bigger and, macroeconomic tailwinds that are going on right now. So again, a positive sign, but nothing to write home about. If we do look at non-GAAP operating expenses, you can see that as a percentage of revenue is coming down considerably, which again is a good sign for the company. That revenue is going up juicily. As of now, cash and short-term investments on the balance sheet are at $400 million. So a little bit later on, when we do take a look at the balance sheet in particular and the cash burn that we are going through, we can decipher whether this is a good number or not, or whether we can expect some sort of capital raise to happen in the next 6 to 12 months, if not even earlier. I won't make you wait around. I will elaborate on it a little bit later. But to me, this is a decent cash position. Now, their updated outlook, they go to fourth quarter fiscal 2023 revenue of 160 to 170 million versus consensus of 162 million full year revenue guidance range revised upward 5 million from the previous midpoint to 575 million to 485 million versus consensus 481 million. So a lot of numbers there, but in general, okay, no big changes. So slightly better outlook, but only if you take the midpoints. They have brought down their higher, outlook, as long as bringing up their lower outlook. But all in all, again, average. And that's kind of what I would have to say about the majority of this earnings report. Despite the fact that there's nothing great going on, there's nothing terrible going on. Chargepoint also guides to improving operating leverage with full fiscal year non-GAAP operating expense of 325 to 335 million, a decrease of $30 million from prior guidance at midpoint. So again, decent. Network charging system revenue was 105% higher during the quarter, while subscription revenue rose 62%. So one thing you'll see a lot of people argue about online is the fact that Chargepoint's subscription revenue, represented by the orange here in the bar chart, is considerably lower than the network charging systems. But one thing that people need to understand is a network charging system has to be sold in order for the subscription to go up. I mean, what are they going to subscribe to without a charging system? This is something we want to see go up in the longer term, and it is definitely going to be a key to profitability, but we can't expect any major jumps. The small jumps we are seeing, I personally, again, as an investor, am happy with. I think people are getting too caught up in this. At the end of the day, revenue is revenue, and, you know, getting those network charging systems up is ultimately going to bring those subscriptions up. So I don't see why people are getting so fixated on this one part of the business. But anyway, overall, those numbers again are very, very good. The electric vehicle infrastructure specialist reported gross margin fell to 18% of sales from 25% of sales a year ago. So again, quite poor, but not a surprise. Supply chain disruptions affected both cost and supply availability, and Chargepoint also pointed to increased new product introduction and transition costs. That is just the way the world is right now. You're going to see this in nearly any earnings report that you do read or listen to. I mean, inflation, baby. Now, before we have a look at what those two analysts have to say, I just want to, again, quickly go through that income statement here. And you see the revenue breakdown here. So you can see our total revenue, 3 months over the 3 months same period last year, has nearly doubled. So again, we already know that. Absolutely fantastic. If we look at cost of revenue, though, we see the same thing. With that being said, gross profit has gone up about 50-ish%, just under maybe 45% or so compared to the 3-quarter ended last year, which again is a fantastic increase. And we can see that as of right now, that gross profit is enough to cover their G&A pretty much exactly. And then the thing is, there's still a lot of operating expenses here between sales and marketing and research and development. Now, this is why Chargepoint is not profitable and is not going to be profitable for another while longer. They need a lot more revenue. Yes, the growth is absolutely fantastic, but without a considerable amount more, they're not going to turn profitable anytime soon. They need to pump this money into research and development and sales and marketing to get this money in. So you can see loss from operations has gone up approximately 30-ish% compared to the same period last year. So overall, it balances itself out a little bit. This is what's going to happen when more revenue is coming through. And again, if you look back at history of certain companies and you look at them when they're at their pre-profit stage, this is a normal thing to see. And it can also, to an extent, be seen as a good thing. They are still investing. But if we look at that loss, if we look at the loss for the 9 months ended, you can see that the cash pile we have at this growth rate of loss is not going to last another 12 months. Just to remind you guys, that cash position is at $398 million. So I do most certainly see a raise in Chargepoint's near-term future. Maybe not 3 months' time, maybe not 6 months' time, but I would very much so bet that by the end of 2023, at the very latest, there will be a cash raise. We can just hope as investors, Chargepoint stock price is able to go up a little bit before this raise has to happen. Or else, you know, it's going to dilute the share pool more than we would like it to happen. Assets liabilities is still looking very good. They can cover total liabilities quite handily. So, all in all, decent. Now, what I would like to do is this. This article just came out very recently. Chargepoint stock is defended by bulls for long-term potential after earnings miss. So, Roth Capital Partners Craig Irwin said Chargepoint reported impressive 93% revenue growth with financial results below expectations, primarily on gross margin headwinds. Looking ahead, Irwin said Chargepoint should see an accommodative market for similar robust growth through fiscal year 24, which is exactly the point I'm trying to reiterate in this video, benefiting from federal and other subsidies. Margin execution is seen materializing as a key driver for stock performance. Roth kept a buy rating on Chargepoint following the earnings report. So, I mean, quite happy to see that. Quite happy to see buy ratings be reiterated after a slightly underwhelming, let's say, earnings report comes out. Evercore ISA analyst James Weston team continue to believe outperform rated Chargepoint is viewed as an index for charging and investors looking for initial exposure to the sector. And I think that is very, very fair. I mean, it's probably one of the first ones people will look into if they're trying to get into that, you know, charging sector, whatever you want to call it. You obviously have your EVGos, you have your Blinks. Tesla, to an extent, is included in the sector. But Chargepoint is more than likely one of the most popular ones, if not the most popular one among retail investors. The stock is expected to be attractive to new EV investors due to its scale, transatlantic reach, and role as the arms dealer for the industry. And very, very fair points. New, higher margin product introductions and a business model well suited for the NEVI program is set to make 2022 and 2023 years of further inflection for Chargepoint. And I mean, so far, yeah, 2022 absolutely has been. Down the road, the long tail of consistent software sales is expected to lead to a superior trading multiple as well. And that's what I was trying to say there when we looked at the percentages of subscriptions in comparison to network charging systems. It's something that's going to build itself up over time, and it's something that's going to make the company more and more valuable, more and more safe over time as well. Investors do not have to determine exactly how the mega theme of the electrification of mobility unfolds, as the company's growth is directly tied to the accelerating adoption of EVs in North America and Europe. And I think that's one thing I personally as an investor like about Chargepoint as well. As EV grows, they are inevitably going to grow. Now, they are the main points of the earnings report. And the reason I think they are down as of right now, again, it's not a surprise. I thought this was going to happen. I said I really do hope that they can stay above that 11.30, even as low as 11.15 mark, stay above support today. Who knows if that's going to happen? Again, if it does reach that 10+% in the red, it will be broken, and the next couple of days going into next week could be scary. But we are going to have to just wait and see on that one. But again, when we look at it from the long term, guys, I think the reason that this downward move is happening is not because they missed EPS or anything along those lines. It's because there was no big updates. And that's the point I reiterated in yesterday's video as well. All you have to do is look at xpeng. So xpeng, they had terrible earnings, but they came out with really good guidance, essentially saying they may be bottoming in regards to the issues they've been facing. They were up 40% on the day. They went down a little bit yesterday, and they're back up another 20% today. That's all Chargepoint needs. Even if Chargepoint comes out with PR in the next week or two, that is just a good press release. I genuinely believe we see a really nice green candle up to the upside. But my friends, that is my personal update on Chargepoint. That is how I feel after going through the earnings report. Let me know how you guys feel about it in the comment section, especially if you are an investor. I definitely do think they're getting to, you know, potentially exciting times to buy again. Last time I bought was right at around this price level. I also did initially buy like back here when they went public at first. But I am not going to sit here and lie to you. There definitely is potential of them coming back down to single digits if we don't get good press release, and if this downward pressure continues, and if we don't see a macro tailwind come into play relatively soon. But if you did watch this video all the way to the end, you, my friend, are a true legend. I really do appreciate you from the bottom of my heart. Your support means the world to me, baby. If you did enjoy, all I ask is that you hit that like button and subscribe for more content, because again, all that helps me out so much. Hope you have a beautiful, blessed day. Hope you have a lovely weekend. I'll see you in another video very soon. Peace.